nice to see some green on the screens here for the last bit, and a lot of that was driven by the talk from the Fed and the slowing in inflation. I know that we've talked a number of times on here that kind of one of the things we're looking for is inflation to peak and start to come down. And great. Thank you all for joining us again. It's been, like I said, I think it was about November when we did our last one. So it's been 3 months here. So kind of like to just kind of bring everybody up to speed on what happened kind of the last bit of the end of the year there and kind of kick off 2023. So as Adam hinted, it was a rough year last year, to say the least, both equity and fixed income. A lot of that was based on, Fed raising interest rates, the inflation talk. We had, conversations early on in the year that kind of transpired the rest of the year with the Russia-Ukraine. So a lot of things, even the midterm elections, it was just a busy year news cycle wise, but really in high inflation and the Fed raising rates. I believe it was 7 times last year for, about four and a quarter, 4.5 percentage points throughout the year that really drove both the equity and the fixed income markets down. So I'll do a little bit of recap there for the end of the year. We finished the year down about 18% for the S&P, 33% for the tech-heavy NASDAQ, and even our fixed income having our worst year ever, down 13% measured by the U.S. Barclays Ag. And we talked about that a lot in our monthly market matters as well as some of our other roundtables. So I don't want to hone in on the total returns there and kind of a lot of the discussion that drove it. But we did finish the fourth quarter with a good little run upward. So we did have a positive fourth quarter, which was definitely welcomed. And we experienced that across the board, both equities and fixed income. So the S&P was up about 7.5% for the fourth quarter. NASDAQ was still flat to slightly negative for the quarter. And then our fixed income did claw back about almost 2% in the Barclays Ag. So that's kind of what wrapped up the year and finished off where we kind of left on our last call. And into this year, off to 2023, we started off with a pretty hot January and into most of February. So been nice to see some green on the screens here for the last bit. And a lot of that was driven by the talk from the Fed and the slowing in inflation. I know that we've talked a number of times on here that kind of one of the things we're looking for is inflation to peak and start to come down. And our readings over the last 4 or 5 months have definitely shown a reduction in inflation. Definitely not back to that 2% number that everybody's trying to target. And you're probably still feeling the high inflation at the grocery store, although gas prices have come down a little bit for us too. But so people looking at the inflation numbers coming down, potential slowing in the Fed and aggressiveness of the rate hikes. So we've already seen a 25 basis point hike as opposed to the 50 and 75 that we were getting accustomed to seeing. So I think that definitely helps as far as the optimism that maybe at some point in the second half of the year that inflation will kind of be back down to normal levels or lower levels, and the Fed may even slow down, if not start lowering rates. So I know that we'll talk about that a little bit here throughout as we dig more into the inflation and the interest rate side of things. But that's really what's kind of driven these markets up this year. And then recently we just had a print this week here regarding that there was a slight tick up in the month over month inflation number. So still trending downward overall for the year over year, but that month over month kind of had a slight tick up. And I think that caused a little bit of a pause in the run up in the markets. And we've had a little bit of a pullback here the last week or so. But overall, markets are still positive as of about, the end of February. S&P is up about 3% for the year. NASDAQ has been on a, straight upward movement here this quarter, this year, following a really bad year that we talked about last year. And that's up about 8.5%. And then our bonds are holding their own. They're up about 0.5% so far for the year of 2023. So that's kind of just a quick little recap of the last year, the fourth quarter, and kind of what we're seeing so far this year and the markets and a little bit of the news with the Fed, inflation, and interest rates. So